let's unpack that for a second, because a lot of things in these financial products that are designed today are very untransparent to the common person. So they really don't know what they're paying at the end of the day, right?
Sure.
So can you break that down of how it says payment and there's no rate in there really?
Yeah, the vast majority of equipment finance products are a hybrid between a lease and a loan.
Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matthew R. Meehan alongside my partner, the professor, Luigi Rosabianca. What's on tap today, Lou?
Matt, you and I see small businesses and entrepreneur balance sheets all day long. And one of the blind spots we hear of constantly is the improper leverage of equipment and their machinery and their vehicles, right? So having the right equipment financing can really help a balance sheet and a company grow. So today we asked Robert Michaloff, the founder and operator of Smarter Finance USA, who specializes in equipment financing. So Rob, welcome to the podcast. Thank you for joining us.
Thanks for having me.
Please help our clients get good equipment financing and get them out of these terrible deals. So tell us a little bit about Smarter Finance, please.
Sure. So, pretty simple. We do equipment financing, and we can do anything from, we've done MRI machines, trucks, both, semi trucks and dump trucks and tow trucks and so forth, and yellow iron. We work with 30 different lenders and investor sources to, we say, if there's a way to get your transaction done, we're going to find it.
Rob, when people call us up, they call us up all the time. They say, I need money. What do you need money for? Well, I own a med spa and I want to buy a cryo chamber, right?
Yep.
They're expensive, but they think they generally need to get an SBA loan or a working capital loan to go out and buy it. They don't think equipment financing exists for that piece of equipment, but you could generally finance almost any piece of equipment out there, right?
Absolutely. Although I will say, if they qualify for an SBA loan and have the time to do that, they should do that before they come to a private lender, because it's going to be, not only is it going to be cheaper in terms of finance charges per dollar, but SBA loan, you can go out to 10 years and so forth. It's a lot easier on the pocketbook. Now, a lot of people can't or don't want to do that, but that's always going to be a first choice option.
So you've been doing this for a long time. We were speaking earlier. You've been doing this for over 12 years. And my question to you is this: what have you seen change in 2026 that's been different over the years prior?
So it's definitely getting tougher. And when I say tougher, in terms of banks are tightening up their lending requirements. Part of that is due to, after COVID, there was a supply shock. And, we heard about the supply chain issues. You couldn't get a truck or a piece of construction equipment new to save your life. There was a 2 and 3 year waiting list. So used equipment prices they skyrocketed. And, folks were buying, I'll give you an example. As a common transaction we do is say a Freightliner truck with 500,000 miles. And since forever, that was a $40,000 to $45,000 truck. And in 2022, folks were buying those trucks for $80,000. And the other thing that was unique 3-4 years ago was both in the construction and the trucking markets, profits were much higher. You talk about spot rates on the trucking market, how much you get paid per mile. And I remember seeing crazy spot rates, $4, $4.50. And they were making, even though they were overpaying for their equipment, it didn't matter because they were making money hand over fist. Well, everything, like it always does, came back to earth. And all of a sudden, people would get back to getting paid $2.30 or $2 per mile driven. And that those numbers make sense if you're making a payment on a $45,000 truck. They make
Mm,
less sense if your payment is double that. It's eating up all the profit margin. And so lenders end up, taking back some of that equipment. And the underwriting criteria figured that you were going to get, 25 to 50 cents on the dollar, but that was on an $80,000 truck. Now, that truck's going for half on the auction market of what it would have gone. And so a lot of credit portfolios are upside down. And we've seen some lending programs disappear as investors that were too greedy, they went out of business.
mm.
So that's the biggest change we've seen in the last 5 years. Is there's less appetite for debt right now.
Yeah, we're seeing that too. We're seeing the banks tighten up across the board. Like you said, the market was flooded with COVID money. We had a supply restraint. People were going out and they were just buying things to buy things because they can get their hands on it, right? And
Yep.
then when revenue dips or profitability, they can't sell at the rates that they used to, right? Goes lower, they got to get rid of the equipment because they start losing money. And then that's where the banks are left holding the bag at the end of the
Totally.
day. So we're seeing that on the SBA side too. A lot of defaults in the EIDL and the current SBAs that we have going on. I have a question for you because we always like to give um, real advice here, right? Let's
Sure.
use a hypothetical example. I own a trucking company because we'll stick on the one that you had, right? So I want to buy that Freightliner now. It cost me about $50,000. I got 3 trucks on the road. I'm doing about $40,000 a month, right?
Okay.
Right now in top line revenue. My credit score is not the best though. It's come down because I use my personal credit cards for everything, which is what a lot of people do because they don't set up business credit cards.
Sure.
So my FICO's dropped from, I don't know, 650 to about 620 right now. If I come to you and say, hey, Rob, I want to buy another Freightliner so I can increase my revenue. What are the things you're going to ask me for, right? What are the terms going to look like? And then
Yep.
where are you seeing rates these days? Just ballpark,
Okay.
not exact.
Sure. So the rates one is the easy one. Time in business, 3 trucks, 620. Rates are going to be in equipment finance. Your contract's not going to say a rate; it's going to say a payment. But it doesn't mean you can't go to an amortization calculator and figure it out.
Let's unpack that for a second because a lot
Sure.
of things in these financial products that are designed today are very untransparent to the common person. So they really don't know what they're paying at the end of the day, right?
Sure.
So can you break that down of how it says payment and there's no rate in there really?
Yeah, the vast majority of equipment finance products are a hybrid between a lease and a loan. And when I say that, they're structured as a lease, but you don't have a buyout at the end. It's a $0 buyout.
Mhm.
But because of the way it's legally structured, we can't put an interest rate like an APR
Mhm.
in the contract. And in fact, the typical thing you get quoted in this industry, and we all do it because it's apples to apples, otherwise you just confuse people, is you get quoted on what's called a simple rate, not an APR.
Okay. Simple
Now,
interest.
when someone asks me what's the rate, people are used to APR, so I'm going to quote an APR. But in general, what you get quoted in this industry is a simple rate, which is going to be much lower than if you calculated it as an APR. And I don't want to get too much into the weeds, like with the math, but as an APR right now, in the situation you described, yeah, you're looking 12 to 15 APR, which, considering a house, I think you're paying 6.5 to 7, I believe right now, is not horrible. Buying a used truck is a small business. In terms of what we're going to ask for in the equipment finance, if you're doing what's called small ticket leasing, which is anything under 250K, The vast majority of the time, it's either going to be application only, which, like I said, is all we're going to look at is the credit, or depending on the situation, we may look at 3 months of bank statements. And what's being looked for on the bank statements is the capacity. Two things: the capacity to pay. So we're going to look at the revenue, the average balances, the ending balances, and make sure that over the last 3 months you're not having NSFs, non-sufficient funds.
No, it makes total sense. You want to make sure that they can afford the payment, right?
Right.
That you're giving them. But what about the term? Are we at 48 months? Are we at 60 months? Something more than 5 years?
Typically, it's 60 months.
Mm-hmm.
Now, at 620, it depends. The lower your credit is, and depending on what issues are causing it to have a 620, it may be a shorter term, right? A 36 or a 48. But the vast majority, I'd say 9 out of 10 transactions that we fund are a 60-month term.
60-month terms?
Yeah.
And it's as simple as 3 months bank statements and application to get started. But now, what about the equipment? When we do equipment deals, we tend to always get an invoice of
Yep.
what they want to purchase first. A lot of people, and I want to clear this up for the audience, they think they can only finance something if it's new equipment. Can you unpack that a little bit?
Yeah, I mean, at the bank, that's often true, or for like in-house financing at some of the dealerships, that's true. But that's not true for us at all. We've got probably 75 plus different programs we have access to.
Mm-hmm.
The maybe 1 in 20 transactions we do is for new equipment. We're usually going to be less competitive on new equipment because you can just call your bank. I'll give you some crazy examples. We did a wrecker, which is a type of tow truck,
Mm-hmm.
not too long ago. That was from 1986. If it's equipment that really holds its value, like drill rigs, I mean, we've done stuff from when Jimmy Carter was president.
No way. I thought it had to be 10 years. 10 years
No.
was it? Really?
With a lot of lenders, it's 10 years. With some, it's less.
Okay.
But there are absolutely programs out there. I think the oldest one we've ever done was like from the 60s. It was like an oil tank. But things like oil tanks, cranes, anything that weighs more than anything that you'd need a special truck to deliver,
Mm-hmm.
usually will last for 50 years. And common sense lenders, now it's going to be a little bit more expensive on a dollar for dollar financing basis than if you finance something brand new. But typically the savings, we'll see someone could buy like a drill rig. We do a lot of drill rigs. They could buy a drill rig new for $1 million, and they're coming to us to buy one for $170,000. So
Really?
paying an extra couple of points a year on the financing means nothing.
And what about if somebody was to acquire one at an auction?
We do auction financing all the time. Yeah.
Oh, you do? Okay, that's good
Yeah.
to know. Yeah, because
Yeah.
I actually had a client last week and I couldn't help him out. But now that I know you, I'll definitely send them your way. He was
Right.
going to an auction and he needed to come up with the money pretty much within a day or two of winning the bid. So
Yeah, we sometimes, folks will find us on the internet and call us up and say, we're going to go to an auction next month. Can you get us pre-qualified?
okay,
And we've certainly done that several times.
that's awesome. That's really good to know. When working with, it's not the most regulated industry, your industry, right? What are some red flags that people should look out for when dealing with a broker?
So the biggest the biggest red flag is online reviews, right? Is every company now has reviews, and you'll see if the company's brand new, I guess that's a red flag too. But assuming the company's been around for a while, you should be able to go to their reviews and sort them. And how many of them are 1 star? And there's a difference between like Google, which you don't anyone can do Google and they don't really care. Like you can buy fake reviews and stuff. The premier ones that you have to pay for, like a Trust Pilot, people can't really get away very well with doing fake reviews on like a Trust Pilot. That's part of what you're paying for.
Mm-hmm.
Now, if it's a legitimate review and you scummed somebody, that'll stay. But you can't do a bunch of fake reviews on the really commercial. And there's other ones besides Trustpilot. That's the one we use. But you look at the bad reviews, and if the bad reviews are like, well, they couldn't get me approved. Well, look, we didn't make you not pay your bills. But if there's dozens of people screaming, these guys ripped me off, a big one to look for, and one that's very common in the industry, is someone complaining that they took money and then didn't deliver financing and wouldn't give the money back, or they took money and then gave you a different rate than what they quoted after underwriting. Like they collected a first and last payment and said, here's your payment. And then they said, oh, well, during underwriting, we found out this, and this. And so your payment's actually going to be $400 higher. And by the way, if you don't move forward, you signed this contract and we're going to keep your fee as earned, which happens.
Is that common
Yeah.
in the industry?
Yeah, all the time.
And then, okay.
Yeah.
So that's I think the audience should know that it's commonplace when financing something. You go in and you give them the first month and the last month's payment.
Yeah, that's like a lot of what we do. They're not all. Sometimes it's like a 10% down payment. Sometimes it's zero down. It really depends on the situation. But first and last is very common. And it's expected. What's not expected is taking first and last, not providing financing, and then keeping that money.
Mm-hmm. So what is considered a good credit score where you can pretty much finance a decent amount of equipment if you're going? 620 is a little low. We had 720 plus side, like regular banking, or what would you say is common?
So there's more than just the score. But in general, which I'll get to in just a second, in general, 650 is like, that outside of something really weird, there's not going to be a problem getting reasonable financing lined up. The exceptions are what is typically looked for is a comp, which exists in almost all lending except like the very subprime type stuff. But for example, if someone comes to us looking to purchase or finance a $40,000 truck, most lenders look for a 50% comp, which means at some time in the past, either on their business or their personal credit, they've at least financed $20,000 in an installment loan. And for most people, that's just having a car loan. Mm-hmm. And it should have been paid on for, depending on the program, 12 to 24 months, just to show that this person has ever made a payment. Secondly, if the business is under 2 years old, especially with pre-revenue businesses, that 50% of businesses fail in the first 2 years, and so lenders are going to look harder at those newer businesses, and sometimes may need a higher credit score or may need a higher down payment.
Okay. And what's this typical down payment size? 10%, 15, 20?
The vast majority of deals we do are first, last plus $9.99 doc fee, so okay. which ends up being 5 to 7%.
Okay.
Now, lousy credit, it could go up to 40%. And when I say lousy, I mean, I did a deal for someone a couple months ago, and the credit score was like 472 or something.
Oh, wow.
Yeah, and so there was no way to do it without a large down payment.
And then what's the typical turnaround time on something like this?
So for Non-titled equipment, right? Anything without wheels and a license plate, assuming the person has their equipment picked out and they get all their documents back. I mean, we can do that in 24 to 48 hours. Titled equipment is a little bit different. Like technically we could do them in 48 hours, but it usually doesn't happen. The two things that trip it up are getting powers of attorney signed and notarized to transfer the title, and insurance agents, right? Is as much as they want to get the deal done, if their insurance agent is not on the ball, which we see all too often, and we literally have an employee here, and her only job is to hassle insurance agents and wear them down until they send us the documents we need.
Oh my God.
Yeah.
And it's a simple document too. It's not really hard for them to do. It's insane.
Yeah. It's just that, actually, I don't know what it is, but it's always been a hassle. There's always the amount of times we ask a sales rep, why is this transaction still on our pipeline? And they say, customer's angry. We just keep yelling at the insurance guy all the time.
Now, do you guys do any leaseback transactions?
A few, not many. The and when you say,
can you explain to the audience what a leaseback transaction is? I think probably a lot of them won't know what it is.
Sure. Well, so there's two types. The easy type is, let's say you want to buy a truck or a excavator or something, and the seller says, well, I've got 5 other buyers. I need the money today. Well, you can't get the financing lined up that fast. So you pay cash, but you really can't afford, or you're not stupid. Like, it's crazy to pay cash for equipment. Almost no one does. But you pay cash, and if you turn it around within 30 days, and sometimes it's 60. So that's the traditional sale leaseback. We do it just as a regular financing transaction. The second type is more of like a cash out refi. And so let's say you've got $200,000 worth of equipment. You can, depending on the program, oftentimes you can go to 50 to 75 LTV on that and get, usually it's 50. And so if you have $200,000 worth of equipment, you end up borrowing $100,000 against it. Now, where people do get tripped up in that transaction is lenders will consider the real price. And by the real price, they mean the liquidation price, the auction price, which is usually half of retail price. And so customers will come in thinking they've got $200,000 worth of equipment. And if it's John Deere equipment, it is $200,000 worth of equipment. And if it's Caterpillar equipment, it is $200,000 worth of equipment. The vast majority of the time, if the customer thinks it's $200,000 worth of equipment, it's $100,000 worth of equipment.
And the bank's only going to lend $50,000 on it.
Right, because if the bank has to take it back, they don't have a lot to sell it at retail. They're going to auction it, and they have to pay the cost to repossess it. They have to pay the cost to remarket it, and they have to pay the cost to store it until the auction comes around.
Yeah, absolutely. Well, Rob, it was great having you here. Why don't you tell the audience where they can find you, how they can get in touch with you?
Best way is our website, smarterfinanceusa.com, or call and talk to one of our salespeople, 866-631-9996.
Great. All right, Rob, last question before I let you run. What is the weirdest piece of equipment you've ever financed?
Probably, I don't know if they even have these anymore with Starlink, but I used to do quite a few of what was called WISPs, which is a wireless internet service provider.
Okay.
And What that is for people in rural areas where you can't get, a Comcast or a Cox out there because there's just not enough people that live there. They have radios, and so these WISP companies would buy, let's say, I mean, they were very small companies too. They'd buy $30,000 worth of radios, and each radio would be like $100, and they'd go and they'd install these in 100 homes, and as soon as they install these in 100 homes, in order to keep growing, they need to buy more radios.
Okay.
And they would have like this antenna thing, and you had to take a helicopter to get to it, and sometimes we'd finance these, but it was super hard to get them like site inspected because you had to take a helicopter. I mean, it's crazy stuff.
Wow. I
Yeah.
didn't even know that existed. Rob,
Yeah.
thank you so much for your time. Everybody, that's a wrap of the Liquid Lunch Project. We'll catch you on the next episode.